So thank you all for being here. Before I start today's talk on talking about fintech and the disruption in banking, let me give you a brief background of myself. So my name is Dr. Raj Iyer. I basically have done my PhD in finance from INSEAD, and before that I did my master's in finance and economics from the London School of Economics. I was a faculty at MIT at the Sloan Business School. I've just moved into London at Imperial College, and here I basically teach financial intermediation and fintech. So I think the way I'm going to think about today's session is I'm going to basically give you my thoughts about fintech and why I think it's so exciting as an area to really explore, and also a brief history about why I got involved with fintech and what is so exciting about it. Now, if you can see from this graph, which I have on the slide, the amount of investments in fintech across the world in different countries is increasing exponentially. And the reason for this has been that there is also a big vacuum which basically banks have not been able to fill, which has led to a growth of fintech. And they're trying to basically capture the space where there is a lacuna where banks are not able to provide these services. And one of the reasons when you really think about the rise of fintech has been that after the financial crisis, there has been a general loss of trustworthiness about banks in the global scenario. And also, in a sense, computing technology, which was very expensive before, has become accessible, so which has led to the use of technology much more in financial services. And as you know, today you can see with lots of students in undergrad and masters and in MBAs, nobody wants to work for big banks because they feel that it's not worth it to work for them because of the bureaucracy and the hours and other things. So basically you have a lot of talent leaving big banks and going into fintech startups. And also in the zero interest rate environment we are living, a lot of companies, a lot of investment funds are searching for yield. So financing has become more accessible. So this genesis of different factors has led to an increase in the whole ecosystem of fintech. Now, just to give you a brief sense about fintech, when I basically started thinking of fintech, the reason I started thinking of fintech was I basically have been very involved with banks and trying to understand banking as a whole as an industry and working with regulators on how to basically make banks safer and reducing systemic risk. Now, the question which always comes about in all these debates is, would banks survive as an entity? Okay, and that has been a very interesting question, because the question which everybody raises nowadays has been that, do you think that banks would exist in the next 30 years? Would we see banks in their current form? Do you think that regulation would lead to a demise of banks and fintechs would take over that space? All these questions are questions which people raise, but there is no answers to it. And at some level, the beauty about thinking about fintech is you are actually thinking of a space which is evolving as we speak. So the reason I started studying fintech academically and thinking about it was this whole question about how is the future of financial intermediation going to look like, okay? Are we going to see demise of banks? Are we going to see a new form of entity? How is regulation going to work in this world? Those were the questions which I was really excited about and also which I was grappling. And I must be honest with you that at some level, these are questions which still we don't have answers to. So when I'm telling you something, it is possible at the end of the day that my thoughts have evolved over time. And there are some beliefs which I held 2 years back, which I don't hold now. And I think that's the exciting part about this field, which is that as students and as faculty and as people who are practitioners in this field or people who face threats and are exposed to this field, it's so dynamic that you basically are creating the field and learning about it as we evolve. Okay, so let me just basically, before really getting on to thinking about fintech, let me just tell you one figure which I have here, which is actually kind of interesting. If you really think of banks as entities which are primarily involved in financial intermediation, they take, for every dollar intermediated through banks, 2% goes in terms of costs. Now, this is a large number, and if you really think about it, the fraction of rents which banks extract from that $1 intermediated is 2%, which is actually at some level quite large. And this has been one of the factors which people have been debating, where fintech would come in and reduce these intermediation costs. Okay. Now, when you really think about fintech, there are different kinds of fintechs you can think about. Before actually getting into this whole idea of cryptocurrencies, blockchains, peer-to-peer credit market. This quote by Mark Anderson is basically a good way to think about where the world is thinking about fintech. Okay, and it kind of, if you can read it yourself, it kind of summarizes that if somebody had to reinvent banking today, they would do it much more differently. So the question which all these entrepreneurs and VCs are raising is, should we think of intermediation very differently in the future? Okay. So having said that, now when you really think about intermediation, there are different ways fintechs really comes into the banking sphere. And actually to really understand that, you need to understand banks, but also where are the different areas in which fintech is really going to come in and try to disrupt banking. Now, let me start with the one which I have studied and which I can basically talk much more detail about. There are other areas which we'll touch on, but let me just talk about an area which I really have studied for 4 years, and I can tell you how I thought about it in the past and now how I think about it. So given that one of the roles which banks perform is lending, one of the key questions which was always there around is, would online peer-to-peer credit markets actually displace banks, and would they improve access to credit, and would intermediation change because of these entities, which are these peer-to-peer platforms? Now, for people who are not aware, peer-to-peer platforms means that I basically can go as a borrower and post myself on these platforms, and there are a group of lenders who could be people like you and me who actually directly lend to you. So basically you bypass the whole banking system and the loan officers and other intermediaries in this whole process. Okay. Now, the reason I basically got involved in this question was because I used to study banks. The question which was interesting was, would these entities actually threaten banks? And I got in touch with the CEO of Prosper.com. As some of you might be aware, it was one of the first players in this peer-to-peer market in the US. And he was a Buddhist, and he basically said that he wants to basically destroy the banks. And his whole idea was that they should not exist and the rents they extract is too high. So his spiel was that at the end of the day, we can do intermediation much better than banks. Now, the key question that was in my mind was, can people like you and me actually figure out the credit worthiness of a borrower and actually lend as accurately to basically minimize default risk as compared to a loan officer who has sophisticated scoring methods? Okay, so what we did was we accessed data from Prosper.com, where we basically got access to all the information that lenders could see for a borrower who was posted on that site. And what was interesting about Prosper was that at the back end, they had a credit score, which they never gave it to the lender. So the lender could not see the credit score. Okay, so lender could see information like whether you had a house, what was your income, but the true credit score, a FICO score, which they had in the back end, the lender could not see. And that was because of some regulatory reasons that they could not show it to the lender. So what we were trying to look at is whether lenders in this market could actually figure out credit risk. And our comparison point was whether they did much better than lending just based on the FICO score. And my prior was that an average Joe in the market might not really do well. So there would be a lot of mistakes which are made by these market participants. And when we looked at the data, to our surprise, what we actually found was that the actual interest rate, which was basically priced in by these lenders to a particular borrower, had a much higher predictability of default of that borrower than just using the FICO score. So basically the predictability of default was 35% better than using the FICO score. So in a nutshell, what that means is that these lenders in the aggregate in the market were doing a much better score than purely lending just based on the FICO score, okay, which was a big surprise. Now, the question you could ask is then that, okay, we thought that these guys are doing very well, so this is great, this market is great. Now, the problem, however, was something which I did not realize, which is that even though these markets on average did a great job in predicting default, the amount of capital which was allocated by people into lending was not very high. So what that means effectively is that these markets were never going to grow big. So if you look at it today, you have a lot of peer-to-peer credit platforms. You have Funding Circle in UK, you have Zopa, in US you have Prosper, Lending Club. But on average, if you look at the total size of these guys, and as compared to banks, they have basically 3% of the total lending market. Banks still are the most dominant force. And in the US, the market has evolved in such a way that the biggest buyers of loans on peer-to-peer credit platforms is banks and hedge funds. So effectively, what started with a way to basically democratize lending and get banks out of the system has led to a world where banks are the biggest buyers of loans. And the reason is that banks are trying to cut down on their intermediation costs. And today, if you asked me whether peer-to-peer credit markets would actually displace banks, the answer I would tell you is no. I honestly believe that banking cannot be displaced by peer-to-peer credit markets. Some of you might contradict my view, but I kind of have come to this belief after a lot of thought on this, that given the fact that banks have the biggest difference why banks will not be able to be displaced away is that individuals like you and me, we need safety. And the fact that there's deposit insurance in banks, people like to place money in banks, and that is why they can do this liquidity transformation. That is, they provide the safety of deposit and they can use that money to lend. Okay, so the question will be at some level, what can these peer-to-peer credit markets actually do? Now, if you think further about it, the key insight which comes about it is that it is true that these platforms which are existing today will be useful to banks because these platforms have much lower costs. Banks have a lot of legacy systems and bureaucracies and institutional structures and regulations, which makes it very difficult to basically lend to small borrowers. So the per unit cost of lending is very high. Well, these peer-to-peer platforms have much more nimble and technologically savvy, so they can have a much lower cost of origination. Okay, so effectively what one can see is banks outsourcing some of their functions to these entities. Now, you could ask me one question, which would be that, is the access for credit at the end of the day going to change? Now, in all the models I have seen, I have never seen a dramatic shift in the way people are accessing creditworthiness. Okay, so pretty much we are going back to the same old data on what is the income of the person, whether he has a house, some data on social media and other stuff, but we've not really seen great revolution in improving access to credit. The interesting part is when you really think about it, I was on testimony at the US Senate, and it was about regulating peer-to-peer credit markets. And one of the guys on the panel along with me was the CEO of Funding Circle. And the question one of the House representatives posed to him was that, what is your rejection rate on the number of people who apply and get loans? And the answer was astonishing. 95% of the people who apply for loans don't get loans. It's only the 5% who basically get loans. Okay, so there is such a huge need, a vacuum of people who want credit, and somehow we have not been able to really come out of a way to think of credit worthiness so that we can price that risk correctly. I think it is a challenge which we have not really overcome, but that is a great opportunity also. So at some level, I can see that at this point, these markets are doing what banks are doing, but at a lower cost. Therefore, they're cutting down on costs and their edges in terms of actually intermediating credit at lower cost, but they're not redefining the way credit is done. Lots of people are trying, but that is something which still needs to be seen, whether we're able to come out with a way to think about credit worthiness, which banks are not already doing, and increase access to credit for people who don't have. But that, I think, would be an interesting challenge moving forward in this space, which effectively could lead to a paradigm shift in lending. But as an entity, I don't see banks as dying, because at the end of the day, as one classic quote, which somebody who was a robber asked a bank, was asked by a judge, why do you rob banks? Because at the end of the day, that's where the money is. So effectively, I do think that banks, because of the fact that they have deposit insurance, will survive as entities and will continue to lend. And the only thing which would change would be the fact that they would do their intermediation through these platforms. So many of them would outsource their lending arms or things like that, because the cost of doing these operations for banks is very high. Now, once you get away from this, one could say, where do you think really fintech is going to make a big difference? Now, I think peer-to-peer credit markets is not really the main area where fintech is going to make a difference. The key area which I think fintech could actually really pose a big change in the way financial intermediation operates is through bond markets. where I can see that technologies like blockchain, which are the distributed ledger systems which help you record transactions in a more efficient manner, could actually help displace custodians and actually cut down intermediation costs of bond issuances. And there are some companies which in the UK which are already working in this sphere. But at the end of the day, these technologies are all about breaking down intermediation costs and making intermediation more efficient. And I think those are the areas where one can really think about how the whole intermediation landscape could change because of those technologies. The other area which one could think about, which has been talked about a lot in UK, is open banking, where you have third-party APIs which can be used by banks. Now, the key used by banks in a sense that these third-party APIs could come into the bank system and actually tap into the information which banks have and create products for the customers. Now, it's interesting. That's a space which is actually very intriguing. But if you talk to a lot of people who are actually trying to get those APIs in place, like think of Monzo.com, and they basically they are pretty much, when you talk to them, the CEO Tom, he would basically say that they initially thought that these APIs were great and they could access a lot of data from banks. But at the end of the day, the problem is that it is very difficult, by the way banks record this data, that it's very difficult for a third party to make sense of it. So that is why they have started their own challenger bank, because they realized at the end of the day, it's a futile operation, because unless the data is recorded in a systematic manner in a way which can be made use by these third parties, it's going to be very tough for them to get meaningful use of this data. So even though there has been lots of regulation which have been trying to open this space up, it's still a big challenge as to thinking of how people can effectively use this data. Now, at the end of the day, again, these questions are really intriguing because we don't know how these are going to evolve and what is the right answer. But it is an exciting area, because if you really think of finance in general, it's very boring at this point. We still are teaching stuff which was exactly taught in the 1980s or 90s. But the only new part in finance is financial intermediation, which is basically being changed by fintech. Now, the question is that basically leaves a person who's an academic like me interested in questions which I don't have an answer to. And for somebody who's a practitioner who's working for a bank, the question is, how is your job going to look like? What do you need to know? And for somebody who's starting in the fintech space, the challenge is that how is this space shaping up? What are the opportunities? What are the threats? Okay. Now, at the end of the day, our sense is that, at least my sense is that I don't see fintech really destroying banks. I think future banks will exist, but they would be much leaner entities, and a lot of their arms will be outsourced. The biggest function a bank will do is deposit taking. So it will have a franchise of deposit taking because of deposit insurance, and the people who are able to economize and optimize that would be the ones which will survive, and then they would be providers of capital to a lot of fintech. And they would incorporate the best practices in fintech and also use fintech for regulation, regulatory compliance, and all these things. But as an entity, they would survive. The question is, how would these fintechs fit into the ecosystem of the banking system is a question which is interesting and is up for debate. So in a sense, what we are thinking about in this course, which you basically must have heard of, is trying to think about this question, okay? End of the day, the course is more about trying to make you think about where fintech is going to basically enter, what are the opportunities, what are the threats, how would banks adapt to it. And what we're going to think about is, we're not going to tell you that we have an answer to all these questions, but we're going to discuss all these questions and think about from domain leaders what their thoughts are and where is their expertise and what is the way they think that industry is going to shape. And also, we're going to have interactive feedback from the students, because at the end of the day, it's basically you're also a market participant, so and you have some thoughts too. So end of the day, it's going to be more about learning together and evolving a thought process together. And at some level, you're going to see me, you're going to talk, I'm going to be talking about alternative credit markets. There are going to be experts who are in blockchain, who are actual practitioners. Then there are going to be people who basically come in from regulation technologies. There are people who are going to talk about cryptocurrencies. There are people who are going to talk about robo-advising and wealth management. These are different areas where fintech can actually hit banks. So we're going to try to synthesize all these different areas where you get an exposure to from thought leaders, so that at the end of the course, you basically have a good sense of where potentially fintech could affect financial intermediation and what are the opportunities and what are the potential threats. I think I have spoken enough and I had a big monologue, and I think I'm going to let you ask me some questions, and I'm going to open the floor for questions at this point. So I see one question which is on what are the views of Amazon disrupting banks? Now that's a very good question. So when I was at MIT, there was a student in my class who basically was an executive working for Amazon. And he basically was mentioning that he was in charge of trying to create a lending arm for Amazon. Okay. And that was interesting because Amazon has wealth of data on small businesses, which it can optimally utilize to create a credit score. So at the end of the day, it is true that companies like Amazon are companies which are basically in the method of UPS. Okay, again, that was another company which was trying to think about lending arms, because they were thinking they have shipments to different small businesses, so they can use the flow of shipments and the flow of orders to understand the business of revenues and other things. Telecoms, okay, these are people who are actually really thinking of lending arms because they have access to data which they can use to get a credit score, and they have good collection mechanisms in place. So I do see at some level that these non-banking entities might actually become shadow banks or actually get a formal banking license to think about getting into lending. So I do think that this space is going to be, at least these guys are really going to actively come into this space. Now let me see, what is the other question? The main thing that has been holding back take-up of methods and tech is the fact that industry has been used to gathering a huge percentage-based cut. Their expectations for doing what they do does not provide value in a comprehensive global average where returns are 5% per annum. Do you think that the industry is capable of getting used to lean times? That's a very interesting question. Now, I'll give you a clean anecdote in terms of thinking about where you're talking about the spread and huge costs, which in the industry has gotten used to. Let's think of bond issuances. One of the big problems in bond issuances, in UK at least, is lawyer fees, okay? Setting up these contracts. Now, I know for a fact that lots of law firms are thinking of the fact that they upfront don't want to charge any fees and charge ex post a small fee based on the proceeds. Now, this is a radical shift in the way they used to think. So I think at the end of the day, once you have competition from new fintech participants, it is true that you will see, to survive, you need to change. And once your survival is at threat, you will adapt. So I do think that these participants will change the way the contracts are structured and will get used to smaller margins, but higher volume. So it could change the way business is done. Let me see the next question. What about emerging areas in terms of finances which banks do not provide yet at all? So that is, again, it's true that you will see a lot of new innovations in terms of wealth management, portfolio management services and other things which fintechs provide, which banks currently don't provide. I can clearly see that these will evolve in a sense, and I think this will help the whole rise of fintech will help shake banks out of their lethargy. But I think the biggest bread and butter for banks is still regular lending. And once they get hit on that, they will also compete on these other services and other domains, which will actually be better for consumer welfare. So this question is interesting. So what do you think, the question is as follows so that everybody knows, what do you think will be the most common reason for fintech banks failing, and what do you think will be the proportion that will fail? Now, that's a tricky one because at the end of the day, this is actually because as compared to banks and other institutions which in the past were in this area, you don't need a brick and mortar presence in fintech. So think of wealth management or think of other services. The problem is it's such a scalable model that you will have one entity which is the most efficient, which might not be the first one starting it, but somebody who basically may not be the incumbent, but somebody who's a second mover also, who provides the most efficient and the best services, who will gain market share. And because it's a scalable model, you will see a winner takes all model. So I can see that there might be lots of fintechs which are starting, but in a space you would not see many of them coexisting. You'll see large agglomeration of rents with few players. So you'll see an industry where 2 or 3 fintechs would actually dominate a particular space. The initial startup will be a lot of companies which are trying to grapple and gain market share, but at the end there will be a few of them who are the best and the most efficient, which would actually survive. Would you therefore recommend people not to work in banking and rather in fintech? So that's a good question. So banks will continue to survive. The question is that your salaries in banks will basically go down because they will have to face lean times. So at this point, fintech is a good opportunity. Banks will also adopt fintech. So I think if you are an expert in fintech within a bank, you still have space to basically get a good bonus and make your living. I think what the next question was that what do you think is the most important thing banks should do to embrace fintech over the next 5 years? I think banks are already in this space. What they are doing is they're looking out at different multiple opportunities in the fintech space. I think banks are also providing a lot of incubation funds to help fintech. The thing which banks would do in the next 4 or 5 years is I think they would basically acquire a big fraction of the fintech companies to basically incorporate within their system. The question which is interesting is banks have legacy systems. So how do you get somebody who is so nimble and so innovative to incorporate into an existing system which is full of all these legacies and difficulties in incorporation in terms of adapting to new systems? That's a question which banks have to grapple with. So if banks basically can integrate the systems and make them more adaptable, that would be a great way to think about how they could survive in a world where fintech is posing challenges, and embrace those technologies and move forward. What are your views on cryptocurrency? Do you think that that will massively disrupt fiat currency in terms of transactions and purchasing goods? Now, that's a very good question. So the question which is, what do you think of cryptocurrencies, Bitcoins, Ethereums, and all these things? I get very scared about these things because at some level, all these currencies are driven by beliefs, and they're sustained by beliefs of market participants who buy these currencies. The question at some level is, you can think about this at once, like the Japanese central bank and the South Korean central bank gave approval for regulatory approval for these currencies. You saw a huge jump in these prices. So at the end of the day, the question is that these currencies are great if they are accepted as a mode of payment, but you need a big fraction of the world to accept it. I again have this belief that a few of these currencies will survive, maybe 1 or 2, but you see so many of them that it does seem like a fad. And at this point, the liquidity of these currencies is so low that if you, at the end of the day, today, at some point when you consume these currencies, you need to change them into $1 or pound at some point and exchange them. And that's where if a bulk of these go for liquidation, you have a huge shock in the market because there's no liquidity in this market. The question at the end of the day is, my sense is I'm pessimistic about all of these surviving. Some of them will survive, but it all depends on regulation. If regulators across the world, like US and UK, large regulators take a negative view on these currencies, I don't think they would have a big future. But the question is, there's going to be some trade-off. So it's not really clear at this point in my head how that's going to pan out. So blockchain, beyond payments, at some level, blockchain is also a very good system if you really think about integrating information within a bank. So lots of banks are thinking about using blockchain just beyond payment system to manage their databases, integrate information within the banks, and also thinking about other mechanisms of holding inventory and thinking about recording transactions. So at the end of the day, blockchain as a technology could help banks integrate much better their existing systems and different arms of the banks talking with each other. So I think that's something which we will discuss in this course. What are the applications of blockchain just beyond the payment system? There's a good question which I have not really thought about. How would fintech affect M&A in this sector? I don't have an answer to it, but I can email back to you once I think about it much more, because I just don't want to talk on the top of my head. I'm not really sure I've completely thought through that one, but I have to think about it. How can fintech benefit microfinance? I think that's an important question. In some level, fintech is very useful for microfinance because it can improve access to credit and reduce the cost of intermediating microfinance. But the question which many microfinance entities and lots of big institutions are worried about is when people have access to money, to mobile money or some financial technology which is very easily accessible, does an average consumer overborrow and increase the leverage and not realize the limitations? And does that hurt consumer welfare and increase defaults? Okay, and how do we think of protecting consumer data and how do we think about consumer welfare is a question a lot of these guys are grappling with. So in a first pass, I think it is beneficial, but at the end of the day, one has to really think about how consumers would update to these new technologies and would they basically fall to some behavioral biases and over lever themselves, which could lead to mass default. So that's a still question which is out on the table. The wholesale banking space. So one question is how we have talked about lending and deposits. What about wholesale banking space? That's an interesting space. At some level, I think that space at some level is so much of OTC that I actually don't, fintech is just another easier, would just help in actually facilitating some amount of intermediation costs in that space. I don't see fintechs completely dramatically disrupting in that space because the participants in that space primarily are large banks, and you can think of shadow banks. In the US, you can think of money market funds, and they are primarily it's an OTC market. You can think of some central clearing which can happen in this market through Target 2 and other things, but at some level you can think of better, more efficient ways to record the transactions and facilitate the transactions, which can actually reduce the spreads in that market, but already they're so low. But I don't see a big disruption in the participation in that market. What do we think about emergence of cryptocurrencies will have on banking industries and the threat they pose? I think that's something which we kind of discussed, but we've not spoken about banks. And I think, let me see, what are the other questions? I think we are running short of time. So in that sense, I think this is an interesting question. I'm just trying to accumulate questions. So how do you think fintech will challenge people's historically entrenched financial habits? Now, primarily what this question is asking is, would people, you and me, consumers, really change the way with fintech? Now, one of the things which you can, if you really look at it, is in the world, if you really think about every country in the world, nearly 30% of individual wealth is held in bank deposits. Okay. Now, and these are the most sticky form in a sense that people really don't reallocate across banks. Now, with new companies which are coming out, which automatically help, at least in the US, help people move money from one bank to the other much more easily, you can see that the threat to the bank in terms of inefficiencies and rates will dramatically increase. And also you can see that many of these fintech providers like in the US, you can think of mint.com, are trying to make people aware of their biases to try to see if they can basically make people realize what these biases are and take efficient portfolio decisions. I think it's an interesting question. Now, people are trying. The question is how sticky our preferences are. We don't know. But I do think that at some level, what fintech would do is Some of the decisions we don't take because of inertia. Fintech will make that much more easy to take. So effectively, you will see much more rebalancing of portfolio, which was not done because of inertia which people had. So I think that's something which we will definitely see change. So let me basically also give you a sense of the program. The program is going to be held on 5th and 6th, and I've touched upon a few things which we're going to talk about, but there are going to be different areas which we're going to cover in that program, and it would be a great pleasure to see you all, and would happy to entertain more questions. You can email me or Julie if you need more clarifications, but I think I should end at this point and let you all have a good evening. Thank you. Thanks a lot.